Let's go to our guest. We've got Ed Perks of Franklin Templeton, where he helps oversee $75 billion worth of money. His fund beat 92% of its peers last year. Ed Perks, good to have you with us here on Bloomberg. So what is the sort of the consideration right now? The U.S. economy doing better, of course, than what's going on in Europe. And many strategists say the first half of 2012 is going to be great for stocks. But then watch out for the second half. Do you agree?
You know, I don't know if we're that excited in the near term. We do think there are still some tremendous challenges for stocks, in 2012. That said, we're looking at the resilience of the economy. The reality of the underlying economy has actually been quite strong. So slow growth, modest growth, recovery can be positive for stocks. I think what was a real challenge in 2011 was the uncertainty and the volatility of that expectation, and that's something that we're gradually moving past. So we are constructive. Now, certainly for our strategy, we're very focused on dividend capture and yield, and that's where we want to focus in stocks.
Do dividend-paying stocks, do they perform well in a slow growth environment?
Yeah, I think that generally is a good place to be in a slow growth environment. What we're focused on not only is the attractive current yield, but also we think there are a number of companies that have a tremendous opportunity for dividend growth. So
increasing their dividends.
Exactly.
I mean, for example, we saw that with Macy's last week, right? Macy's coming out, the retailer, doubling the dividend.
One of the things that we're pointing to, we think is very constructive about dividend-paying equities today is fairly low payout ratios. So the amount of earnings that are being paid out today in the form of dividends is relatively low compared to historical ranges.
Why is that? I mean, did they have problems with their balance sheet? Did we go through this period of balance sheet repair?
Yeah, that's a great point, Pimm. If you look back the last 3 years coming out of the financial crisis, companies really turned inward, and then that was the primary focus, was balance sheet repair, reducing debt, extending out maturities, reducing interest expense, and the markets have been pretty accommodative. The corporate bond markets have been very willing to issue that new paper. Companies, though, now are transitioning. We think it's a little bit more about internal growth, some opportunity for M&A, which we have seen increase a little bit in the marketplace, but more and more returning it to shareholders. So that focus on dividends has come back a bit, and we think that can be a real theme over the next 5 or 10 years.
All right, now you talk about these dividend-paying stocks and companies returning more money to shareholders. If that's a theme that everybody knows, should you avoid that trade? Should you avoid that investment? Or should we just keep it simple and not ask too many questions? Say, all right, look, dividend-paying stocks and those that are going to be increasing their payouts.
Yeah, well, it's certainly become a more popular theme in the market. I think our strategy, Franklin Income Fund, goes back over 6 decades. We've been doing this for a long time, focusing on dividend-paying equities. Now, I think if you go back to the beginning of 2011, it's interesting that several sectors that are known as paying higher dividends, like electric utilities, like telecom services, they were generally out of favor. So there was a really nice opportunity. As the year progressed, they generally performed well. At the end of the year, they wound up being some of the stronger performing stocks in the market. Today, what's interesting to me, when you look at the broader equity market, the S&P 500, today we have 7 sectors in the S&P 500 that have a higher average weighted dividend yield than the 10-year Treasury.
Well, the 10-year Treasury, 1.9%, right?
Exactly. But when you're looking at relative value across asset classes and an opportunity to find some yield, there's a very broad range of the equity market today that offers you that relative to fixed income.
I don't hear you tell me anything about energy, and I know that, Chevron coming out after the bell today and saying that the fourth quarter results are going to be significantly below third quarter results. Energy fit into your strategy at all?
It does. We do like energy, and we do hold some Chevron. We like ConocoPhillips as well. I think there's also a nice opportunity in some of the broader segments of energy, so away from the integrated oil companies, focusing on some of the service companies. We think production profiles going forward are going to continue to get more service intensive, and that's something we like.
$101 for a barrel of oil. People think that that's steady and consistent, and you've got, what, $3.35, $3.50, the range for gasoline. You think it stays there?
I'm not quite sure I'll expect that range or that ratio between oil and gas to stay the same. We do think over time that ratio needs to come down a bit. But at these prices, particularly in oil, it's a very profitable environment for upstream activities, for exploration and production. Now, gas markets certainly have been under pressure. The very warm weather in the country so far this winter.
Natural gas down 5.5%, almost 6% today.
Yeah, now certainly that's kind of near-month influence from this building of inventories, the very warmer conditions. I'm happy to be in New York in mid-January and have it be 45 degrees. We think over time that fundamentals will catch up. There will be reduced drilling as the economics of certain plays starts to become more more challenged at lower prices, and we'll see that kind of self-correcting.
And you mentioned bonds. What about if people have capital gains in bonds? Take some of that, put it into stocks, you think?
You know, we have been. If we look over the last year in Franklin Income Fund, our mix between fixed income and equity has actually become more balanced. So we've reduced fixed income. Some of that has been profit-taking. The decline in spreads, the decline in interest rates that you mentioned has created an opportunity, I think, for some profit-taking, particularly bonds trading at big premiums over par value, still having a lot of long-term interest rate risk. That's something that we're trying to reduce the exposure to in our portfolio.
All right. Rick Bensignor is the chief market strategist at Merlin Securities. He's the former chief technical strategist at Morgan Stanley. Also with us, Jonathan Henes. He is the bankruptcy partner at Kirkland Ellis. He's going to talk about austerity in Europe. And also we have Ed Perks, who oversees $75 billion at Franklin Templeton, in a mixed bag of equities as well as fixed income. He's the one with the bigger headaches, Rick, right? Yeah, exactly. Well, you tell me that maybe people should be protecting some of their profits, right? I was just going through the numbers. NASDAQ up 4%. Dow Jones Industrial Average up nearly 2%, 1.9. S&P up almost 3%, 2.7%. So, what, do you take a little money off the table?
Well, not quite here yet. We think the S&P is going to probably get to 1310 as a minimum upside target. We're not all that far away, but, you know, look, we try to be tactical within a strategic backdrop.
What does that mean, tactical with a strategic?
Well, it means we're willing to trade within what we think is the bigger picture. Back in the middle of December, we turned bullish when the S&P got between 1220 and 1200. That was our entry point. We've got now, what, 80-plus points or so, give or take, from there.
Right. We're 8 points away from 1300 on the S&P.
Right. So we think you probably push. We said in our opening piece for the year, we said we think the S&P, the first move this year, is at least a 5% move higher. So we're halfway there. We're going to still go some more. And my guess is it's not so hard to think we could see 1330, 1340. Maybe, best case scenario, you test last year's highs near 1370. But I can't make a strong case for why we go much beyond there. So I'm trailing sell stops. Think of it that way. The more we move up, the more we'll move our sell stops up, protect some of the profits because we're long 60, 70 points lower, and just make sure that if something happens, we don't walk away from everything.
You don't want to give it all up.
No, of course not.
All right, Jonathan, giving it all up. When I take a look at the dollar versus the euro, 127, 16th month low. Right, against the dollar. We've been looking at this correlation that supposedly exists, right? If people want to buy the euro goes up, that means great, go ahead and buy stocks. Is that correlation, you think, does it really matter?
Hey, look, I'm a restructuring lawyer. I'm not a stock picker like these guys. But my view is.
But you got a view on Europe. I know that.
I have a big view on Europe. When you look at Europe, right, and we talked about this earlier, right? They have austerity measures in place, right? So what does that mean? It means we're going to cut spending, we're going to raise taxes, and we're going to have growth continue to slow. So Europe's going to be in a recession. So there's no wonder the euro's down compared to the dollar. But also, in some ways, you could argue that the euro's a failed experiment. I mean, we'll see. Maybe they'll pull it out, but I think it's difficult. And the reason for that is you can't have monetary policy that's a one-size-fits-all for 17 different member nations. They all have different issues. They all have different problems.
Yeah, but we got that here in the United States. We got one monetary policy for 50 different economies, don't we?
Well, not really, right? What we have in the United States, we have monetary policy, and the major fiscal policy in the U.S. is the U.S. fiscal policy. That's why you pay the vast majority of your taxes to the federal government. At the state level, you have balanced budget amendments in 49 of the 50 states. But what you have that you don't have in Europe is we're all Americans. I don't know where we're all from, but you know, I'm from New York. If you're from New Jersey, you're from Alabama. We're all Americans. That's our nationality. When you're in Europe, if you're French, you're Greek, you're Italian, that's what you are.
So you got divergent interests. It's like the doctor prescribing one medicine for everybody in the hospital. It doesn't really work.
It doesn't really work.
So what do you think happens? You think that Greece leaves the euro?
I personally think the best thing for Greece to do would be to leave the euro, because I think in order for them to work out their problems, you know, if you go start printing some drachmas and, you know, create your own monetary policy, you're probably going to get out of the situation better rather than just being I don't want to call them a puppet state, but a state that's not going to have any economic growth. And they've just got, they have massive problems. One of the things in Europe, though, that also people are not talking about, although I think I did see it on Bloomberg.com today, might have been Bloomberg.com, is the pension liabilities,
that's
right? People are just not talking about it. And that's impacting us as well. We're going to probably see some austerity in the U.S. over the next decade because of the pension liabilities, where you're going to see states, and we're already seeing it, raising taxes, cutting spending, slowing growth. I don't know how the stock pickers look at that, but I would think we're going to see some slower growth in the U.S. over the next number of years as well.
Ed Perks, let's just buy into Jonathan's idea that you have maybe Greece leave the Eurozone. Would that be bad for stocks in the United States? Would that be bad for U.S. investors?
You know, I'm not sure that event would be all that meaningful. We're really looking at more of the core economy in Europe. So really how
we've certainly talked the idea of one of the member nations leaving the euro. We've talked that idea to death.
Yeah, and I think the core economies, Germany, France, Spain, Italy, are really where we need to focus. One thing that I think is worth pointing out is, you know, as we look at many of the companies, say the S&P 500, the average exposure to European markets as, say, a percent of revenue over the last couple of years is pretty low. It's single digits, below 10% for your average company. Now, there's a wide range there, something like an electric utility with no exposure to Europe to something in, say, auto or supply, where it's closer to maybe 30%. But there's a range, and on average for the S&P 500, we're talking about 7 or 8% of revenues.
All right, stick around. We've got much more. Rick Bensignor, this idea that the U.S. economy may be getting a little bit better than people expected. You take a look at things like the housing stocks today. Sure. They moved very, they did very well today.
Yeah.
So if you take a look at a long-only manager, someone who's trying to read the tea leaves, do they look at the economy, they look at stocks that are up so far this year, and they say, look, we got to get in. We can't wait for a better price?
Well, I think a lot of people are thinking over the course of the year, you'll probably have in round numbers, if we're close to 1,300 in the S&P, that you'll have a better chance somewhere lower. We started the year at 1,257, which is the same place we started 2011 a year ago. I think we're still going to have kind of a meandering type year, but how much do you want to trail a benchmark? At this point, it's only a few percent. The market's only open 2 weeks so far. But my guess is if you start pushing over 1,300, there's a point at which somebody's going to feel uncomfortable from a market that started at 1,257. And if you don't have enough exposure on and you're a long only, and let's assume there's some cash that they have on hand, that if they're in the wrong sectors, and look at the disparity already, the best performing sector so far is up 7%. Materials are up 7%, and utilities are down 2.75%. So
no one's getting defensive.
Almost 1,000 basis points spread already in less than 2 weeks of trading between the best performing and worst performing S&P group. The name of the game for me, and it's what I've been telling clients for a long time, this game is about beta. It's about being in the right sectors at the right time. It's not so much individual stock picking. It's being in the right groups. Because if you're in the right groups, you really have a chance to at least match benchmarks and hopefully outperform. But if you're in the wrong groups at the wrong time, you get your rear end handed to you, and that could absolutely destroy your year. So it's really, I think, as much about making sure you kind of stay with benchmarks, but be in the ones that you have the best chance for juice. We started the year off, we said go into financials and go into materials to start the year. We like utilities a little later in the year. They're actually on our favorite list, but not to start. We said let them sell off, let profits come out of utilities, then come back into them. Because I think at some point, whether it's 1350 or somewhere, give or take, the market will kind of peak and then pull back again. And that's when utilities will come up. People will go after the higher yielding dividend stocks, and they'll shy away from some of the cyclicals that started the year off with a bang.
Ed Perks, luckily we've got a long-only manager, right? We've got you. Tell us, is this really a thought that matters for managers? They start to look at the benchmarks, they start to look at what they've invested in, and they say, you know what, we can't wait for that big sell-off. We got to get in. We got to do something.
Well, I absolutely agree with Rick. In the short run, it is about that sector call, and the two sectors he pointed out. It's interesting that that's almost a complete reversal of how they ended the year. Exactly. Utilities really outperforming sectors like materials. So a little bit of reversal to start the year. You know, we do think in the short run that really can dominate how the market performs, or different segments of the market can perform. Over time, our process is really based on the fundamental research, focusing on individual companies.
It's not a stock market, it's a market of stocks.
Exactly, and we think over time and intermediate and long run that really can help determine a lot of your success.
Jonathan, I don't want to leave you out here because I want to follow up a little bit more on Europe, because every day we come in and we take a look at what is coming out of Europe, and we say, all right, that means that U.S. stocks are going to sell off, so we look at the close in Europe. Is there a point at which we just kind of let Europe go its own way, and we say, you know what, we're going to focus on the United States. We're going to focus on companies that can grow their profits regardless of what happens between Nicolas Sarkozy and Angela Merkel?
Yeah, I think if you can, and this goes to the point made before, I mean, if you can focus on U.S. companies that are only in the U.S., but anybody that has any exposure to Europe, you need to focus on that. But I think more importantly, and we haven't heard a lot about this as of late, but what about the banks in Europe, right? And what happens if it's not just Greece? Because I agree that if Greece comes out of the EU, it probably doesn't make a big difference. Spain, Italy, if those countries continue to have problems, we could have a major problem. And if they have to do a real debt restructuring, which I think at some point they're going to have to do, it's going to impact the banks. And without recapitalizing those banks and making sure they're fine, you could have another banking crisis. If that happens, again, I'll leave it up to the experts because I'm not smart enough to pick stocks. You know, I don't know what people do at that point.
But a banking crisis, doesn't that mean a banking opportunity for those banks that are healthy enough to come in and take the business that the European banks are giving up?
Potentially, but banking crisis, and we saw this in 2008, right? I mean, a banking crisis comes on quickly, and it seems to infect very quickly. So potentially, you never know what could happen. Maybe some healthy banks could go take over some assets, but my guess is if we have a banking crisis in Europe, it's going to infect the U.S. and the rest of the world pretty quickly. And then we're all going to have to figure out how to dig our way out of it.
Rick Bensignor, the memories of a banking crisis in the United States, 2008. Do you think that many investors are prepared for a potential banking crisis in Europe?
I think it haunts them from owning banks in a big way, which is part of why, after financials got squashed last year so much, that we actually wanted to start the year and come right back into them. Yesterday, we put out a flash note. We said, let's get into regional banks. We actually like that part. So the real estate side of financials and regional banks are our two favorite subsectors within the financials. And that's where we think if you want to start the year and you think the market's going to be bullish, that's the place to be.
All right. Now